So nice to see all of you here today. So, we do these quarterly updates. And so, Marty, you're on here with probably about 100 people. Careful what you say, okay? And we do these quarterly updates to just sort of get together with you and chat about what's going on in the apartment business. It's not too formal. You should turn your camera on. You're all on Zoom. If at the end there's time, we'll just open it up and chat a little bit. And I want to encourage questions. Put them in the chat room, okay? And I'll try and answer them at the end. So the purpose of today is just to give you a broad overview of the market. In every quarter, I'm going to have, 50 to 100 discussions with apartment owners, developers, lenders, appraisers, and I want to synthesize what I've learned and try and say, and maybe try and guess as to what's coming down the pipeline. Okay. So first things first, Rod, let's go to the first slide. I don't know how many of you saw this slide, but I had a beautiful experience this summer in Rome. Anybody recognize the guy in white? Of course, the Holy Father, Pope Francis. And so I was lucky.
We just lost Derek. We'll get him right
sitting
back
beside
on.
the Holy Father. Yeah. Hey, sorry, Mike. That's not my computer, right? That's having the charging problem? No. Okay, good. Anyways, so there I am in Vatican City, and I got to meet the Holy Father for about maybe 35, 45 seconds. I asked him where cap rates were going. He said, I don't know. Okay, but anyway, it's a beautiful experience. I just wanted to kind of share that with you. It's one of the things I kind of wanted to do in my life is meet a sitting Pope. Okay, next slide, Rod. So, we're in the business of, we're brokers. We're commercial real estate brokers. This is what we do. But our best form of, keeping, getting, and maintaining our relationships with our clients is through education. And we've got a couple of, I think, really interesting events coming up. Next week, we're running an event on how Canadians take money to the USA to invest there in apartment development. The US market is bigger, more vibrant, also riskier, both on the upside and on the downside. And we've created we think, a very good process to help people who are looking to invest in the US in the apartment sector by going to the right state with the right developer and so on. So we're interviewing 2 developers in 2 particular markets. I think if you're interested in apartment development and the USA, this is a great webinar to learn about it. This year at Toronto Real Estate Forum, the major real estate event in Toronto, we are sponsors and running the Apartment Development and Affordable Housing Conference. I'm going to talk a little about affordable housing today, but this is a large event we attended. I think Toronto Real Estate Forum is about 2,500 people attending it in total, and this is on November 28th, a breakout session. Here's the agenda for the session, and maybe with Rod, we can pop the link into the chat room if people want more information. Or Rod, sorry, go back one slide. You'll see that below each of the events, there's a QR code there. So if you want to get details on that, pull your camera now and just take a shot of that event. And then the third event that we're running, and this is March. This is 11 webinars, all on new apartment construction. Each session is 90 minutes long, and there's one every week from January to March. This is the 4th time we've run the Apartment Developer Masterclass, and it's for anybody interested in participating in the apartment development boom, which we think is going to come. And I'm going to explain a little bit later on why I believe there's going to be a significant apartment development boom here. So far, the people that are registering are generally, I would say, the younger staff of apartment developers and the children of apartment developers and financiers who are saying, we don't have time to teach our people the basics of apartment development. That's what this course is. Okay, Rod, next slide. All right. Okay. So, we've also just as an aside, Rod and I wrote this book called The Self-Funding House, and it answers the question, how do young people buy a home today? Well, the answer is they become landlords. And really what we're saying is duplex your house, triplex your house, put in a backyard apartment. So we wrote a book on the mind shift, and one of our clients, Ironstone out of London, has gone ahead and built some of these, and they actually got an award for for building affordable housing, for innovation, for the oldest concept in the world of the duplex, the triplex, and so on. They actually built a formal product like this called Flex House, and it was based on our book, The Self-Funding House. We see this concept, not going to talk about this a lot, but we see this concept of the self-funding house as being a major solution to the crisis of how do my children afford a home, and how do we create affordable housing with very little government interference and so on. All right, okay, so let's get started, right? So this is what I want to talk about today, okay? And I'll just talk in each category generally, and where I can give specific examples, okay? So the first thing is, right, okay, next slide. I think that the shifting focus of the marketplace and of brokerage is occurring right now, okay? Next slide. And we're in the middle of it, and sometimes you don't know what's going on up until you're past it, right? And so we've been seeing commercial real estate problems, not in the apartment sector. I would say, for sure, they're not in the apartment sector. And I wouldn't even say not yet, because we don't see a lot of pain coming in the apartment sector. We see a lot of going sideways at the end of the day, but not a lot of challenges. But certainly in office and in probably raw land and things that are just going very sideways and very going down right now. There's a lot of product coming to the market for sale, but there aren't a lot of buyers in the marketplace. They're certainly not at the prices that people are expecting. And then I think it's just a matter of time before, the gap between buyer and seller, it's pretty wide right now, but that's going to narrow. There's going to be a reckoning coming, and it's usually, I think, it's the buyer that's going to win, and the seller is going to have to sell. Is going to sell, and the one who doesn't, probably isn't. But I mean, you read about this stuff, regularly. So there's no point in talking about it in great detail. But we're going through the change right now. We've been in it for a while. The problem is you don't know till it actually happens. Okay, slide. So we think that the business of brokerage, and I'll show you a slide a little bit later on, has changed quite dramatically. And I think that the people that are tied to transactions and the people that are tied to, a brokerage, mortgage funding, and things like that are going to be in for probably a rough ride. And we think that, can you guys, it looks like I'm not moving here. Everything good? Just give me a thumbs up, Rod.
Yeah, you're coming through just fine. Just your video's frozen, but that's okay.
All right, okay, all right. So it's just like a picture of me there. Yeah. So we think that as an apartment brokerage firm with a significant size staff in our research department, our brokerage department, and our marketing department, we're switching our focus. Of course, we're brokers, that's what we do, but brokerage is down significantly, right? So we're working now with private families who are bringing their children into the business and educating them on the business. We're doing mid-market land deals, and we're also, this is a really interesting business. Cash right now is king. A few years ago, when interest rate were 2%, everybody was not worried about raising cash because money was so cheap. Today, money is hard to find and money is expensive, and we're helping our developer clients put together the top part of the capital stack, the equity piece, to finish off the apartment buildings they also have under construction. And we're doing several lease ups today of newly constructed apartment buildings that are coming to the market right now. And but the marketplace is relatively strong for rental, surprisingly strong. And I don't know if I see much of a change coming in that. There will be pockets where it will get harder and things like that. And I'll talk about that a little bit later on. Okay. Next slide. So some of you know Dave Price. Dave, you're here. Dave is our director of sales, and he's usually the first point of contact for most people in our company. There's Dave's phone number and his address, and there's a QR code if you want to book a meeting with him on any of the services that we have or the things we talk about today. Dave will be able to sort of get you started. The things that we spend most of our time on today are family businesses that are looking to transition from one generation to the next, or to sell, or sometimes to separate. New apartment construction is the bulk of our work today, and we think that new apartment construction is going to actually get a lot better. I'll explain why. And then just overall investment opportunities for those of you that are in the marketplace, but everyone's being very careful and understandably so. All right. Okay, next slide. All right. So overall, the economy. Look, nobody knows where the economy is and where it's going, but the question that I ask everybody when I meet them in these, let's say, 50 conversations I've had is, what is your current opinion of the economy? And I would say that 80 to 90% of the people have a negative comment when I ask that question. Look, it's very easy to be negative. I get it, right? It is. But, and then the other 10 or 20% of people who don't have a negative answer say, we're somehow getting through this. It's going to be okay. Federal policy and things like that are going to be able to offset what we're in right now. But overall, I think the view of the marketplace is that this is a difficult market that we're heading into, and clients and apartment owners like you, need to adapt, right? And I think what's happening in the economy in general for an apartment owner who owns like there's two classes. The people who are building buildings are under pressure right now. Okay, the people who own apartment buildings are probably looking at a period of time where things are going to go sideways, but I think your NOI is probably going to go down. Okay, I'll speak to Ontario only here, right now, but we've got essentially a sitting tenant is protected in his rent, except for on newer buildings. And when that tenant moves out, you can raise the rent, and sometimes you can renovate the unit and raise the rent, pretty significantly, right? That turnover is going down, and it's been going down for a while, and it's probably the lowest it's ever been. So if you've got an older building, let's say built before, 1998, sorry, 2018, so many changes in legislation, 2018, and most of them were built in the 50s, 60s, and 70s. Your turnover of your tenant who is paying what I would call a chronically depressed rent, so it's hundreds and hundreds of dollars below what the market is today. That turnover, I'm going to guess, is at 5%. If anybody wants to put a comment, in the chat room about their turnover of the older tenants, it's probably down to 5%. And that was for a lot of people the play, right? When people moved out, you went in, you renovated the units, and you were able to raise the rent substantially. You bought buildings with lower rents in anticipation of tenants turning over, and that turnover has dropped dramatically. Fair enough. So the business model of relying on turnover to boost your income and to make the deal viable, I'd say that strategy isn't working, right? Now, for those of you that have renovated a unit, and let's say you're closer to market rent, so you renovated it last year, and you took the rent from $1,000 up to $1,500 or $1,600, if that's the market in your area, then those units are turning over at a different rate. Those units maybe are turning over at 15 or 20%, right? So within the same building, you've got the old tenants, the long-term tenants who are way below the market, turning over at 5%, and you've got the newer tenants who are playing closer to market rent, let's say turning over at 20 or 25% for kind of an average turnover rate of 8, 9, or 10% or something like that. But you can't say the turnover rate is 10%. You've got to look at it on a bifurcated basis with the units that are renovated and the units that aren't renovated. And even the units that you renovated, let's say 5 years ago, and somebody moved in, that rent is still below the market. So if that person moves out, you'll get a lift in rents, not as much as in the one that's, the tenant's been sitting there for 20 years. So the overall economy is probably going sideways. Maybe it's starting to go down. This is the most anticipated, recession in history. And your turnover is going down. In the meantime, while your turnover is going down and your rent is essentially capped at the guideline, which is probably going to be 2.5% again next year, but your expenses are going up. All of you have seen your insurance rates go up, I don't know, two, 3 times, right? We used to, when we would pro forma apartment buildings, we would put in, 3, 4, 5 years ago, $150 for insurance. So you're going to have to put in $300, $400, $500, $600, maybe with a higher deductible, and that just all comes off your bottom line. So my guess is that, even let's take financing out of the picture. You've got long-term financing in place. You own your building for cash. You're going to see pressure on NOI, and so for many, many years, there's been pressure on NOI, but cap rates had been going down because interest rates were low. So people were equity rich but cash poor because they said, my costs are going up and my rents aren't going up. Today, I think both of them are probably, heading downwards because cap rates are going to readjust with higher interest rates, and NOI is under pressure because you can't raise your rent and because your operating costs are going up. And so that's going to make, your cash flow go down and the equity is going down as well. But we don't really see and don't anticipate really any fire sales occurring at all. Okay. There are very few apartment owners that are over their skis. The only apartment buyer of older product that could be in trouble is someone who bought a building in the last couple of years. They overpaid for the building. Their business plan was to renovate the turnover suites and raise the rent, and that made the deal work. Okay, and they kept a floating interest rate in anticipation of raising the revenue and then refinancing and locking in. So that person got caught two ways. When they refinance now, it's a much higher rate than they anticipated 2 or 3 years ago, and the opportunity to renovate the unit has gone down because tenants aren't moving out, and as a result, that's created a number of problems. Sarah, would you come down here? I think I know the problem is. Okay, well, my camera's not working. Okay, we could probably just fix it in a minute, and I can just hopefully, Rod, keep talking through this. Okay. Okay, Rod, let's go to the next slide. Okay, so this is the number of apartment transactions that occur across Canada, and we put this out on my LinkedIn account. So you can see that the black line, there's a steady reduction in transactions. Fair enough. I mean, there would be 80, 90 a month back in 2021, and last month there were 12 transactions that occurred. Also, the average size of the apartment transaction is going down. Okay. And so, yeah, so the average size of apartment transactions going down. And so if you said to us today as brokers, what would you rather have? One $200 million deal or 10, $20 million deals? I think every broker you meet would say, I'd rather have 10, $20 million deals, right? Bigger is not better today. People don't want to take a lot of risk. Nobody wants to buy a $200 or $300 million, portfolio or apartment building on one corner, right? Okay, so transactions are heading down, and people do not want to take a ton of risk here, right? And so you're going to just see that I think that the marketplace is going to stay frozen. It's going to be hard to know what cap rates are because there's so few deals occurring, and the deals that are occurring oftentimes have financing, better than market rate financing in place, and that's why people are paying maybe a lower cap rate because they're inheriting a good 10-year mortgage that was put on 2 years ago. So you really have to look behind the deal to understand where the cap rates are. But logically, interest rates go up, cap rates have to go up. They do not go up lockstep. And if you go back and look at some of the other webinars we've done, we talked about this quite a bit. So transactions going down, deal size going down, and apartment price probably going down on a per unit and on a cap rate basis. Okay, next slide. Nobody knows anything about the economy we're in, but if you look at sort of the real estate cycle and you had to guess where we are, and you had to guess where we are for Ontario, because I think Alberta would be in a different place. I think we're kind of approaching the bottom here. You never know when the bottom is in. You never know when you have the top, right? But I think that we're approaching the point where there is some regret and fear of people who wanted to get out, okay, or people who bought recently, because it looks like we're heading into, a more difficult market. The apartment business, I think, never really goes into despair because, it's not like hotels, it's not like office, it's not like retail. People always need a place to live. When the economy starts breaking down, first let me say this. The greatest threat to the apartment business is not recession, okay? It's overbuilding. When there's too much supply and a recession combined, it's bad. Just a recession alone, people just tend to stay put. So if your building is full today, and if we head into a difficult recession, yeah, vacancies are going to go up a couple of points, and you just got to stay on top of it, make sure it doesn't get away from you. The only time that there's really any pain is if you're in the middle of a lease up, right? Because the whole market kind of freezes up. But once you get full, whether you're A, B, or C class, you're probably in pretty good shape if we have a recession. If the marketplace gets overbuilt, and by the way, we're Canadian, no place is overbuilt, not even close to it. But if a marketplace does get overbuilt, that's when you see pressure on rents, okay? Recession or no recession. And, the A-price guys built a brand new building. There's a ton of competition. They have to drop their rent. Sometimes they drop their rent so much that it puts pressure on the B, because the guy living in the B building says, wait, for a couple $100 more, I can be in a brand new building, at least till that overbuilding gets, sort of taken up. So I think we're in this part of the cycle here. I think Alberta's probably in a little, better position where there's more optimism and things like that. But probably for Eastern Canada, mostly would agree that we're approaching the downward end of the cycle. Picking the bottom is always difficult. Nobody can ever do it, but certainly there's going to be some opportunities. Okay, next slide. So where's some good news in this? Well, for those of you that are contemplating new apartment construction, either building it or buying a finished building, I think things will get a little better with the GST and the HST removal. It's going to vary across Canada, but I think in Ontario, you know, both the provincial sales tax and the federal sales tax, both the HST is going to remove, and it does have actually, you know, a positive impact. I'm a bit of a Ronald Reagan fan, and you know, Reagan had this phrase where he said, you know, this is what you should be concerned about. I'm from the government and I'm here to help. Well, you know, the government has been meddling in apartment development and rent control legislation for a good 40 years, and it's kind of got us to where we are right now, right? And I don't think, well, the government has a role here for sure. It's to back out of the business and take away all the taxes and all the bureaucracy that's in the way. But we really need the government to get out of the way and free up the private sector to build apartments. There's no way the nonprofit sector, who has really no money and not a ton of experience, can put thousands of apartments in the ground. One private developer could put 200 units into the ground and be under construction before a nonprofit had their plans ready. It's just a bureaucracy. They don't have money and things like that. This is going to be solved by the private sector. So government has been in the way here. It's time for them to get out of the way, and to a little bit of credit, you know, they did bring in this change in the HST. Okay. And Rod, next slide. So there's been a ton of talk in the news, right? And it's been pointless because it's been finger painting. Who's caused the problem? Who's caused the problem? It's the greedy developer, it's the bad government. Doesn't really matter. I'm going to stop talking about it, right? But we've got to move forward to solve the problem, because it's been defined as a crisis. And if there is a crisis, this is a rich country. And at the end of the day, there are going to be enough changes made for new apartment construction to make sense again. And those changes have to occur, I'm guessing, 40% at the federal level, 20% at the provincial level, and then 40% at the municipal level. That's probably where the cog in the wheel is, right? So the federal government has, you know, stepped up and said that they're going to, for 5 years, remove the GST, HST tax. Rob, you go to the next slide. We're going to show you what this does to an apartment pro forma. Okay, so you know, normally when you on the left-hand side in the self-assessment, you've got to pay, you know, on this building, which is how much? $100 million? No. $36 million, no, $36 million deal. Okay, you would pay $3.5 million in your self-assessment of your HST. Okay, and so that number has now gone away. In the next slide over, you'll see the self-assessment is zero. Okay, so go to the before example. The borrower required, you know, $13 million in equity on the first deal. Now that person needs $9 million of equity. Okay, so that's so that HST comes right out, or goes right to the equity line sort of thing as a credit, and the CMHC mortgage loan is still the same amount, right? So it gets them better leverage at 79% as opposed to 73%, and so this is a step in the right direction. We need several more steps in the right direction to make new apartment construction go bigger, faster, cheaper, and easier, but at least this is the first move that's coming. I think if the federal government brought in the old MERB program, and that would be easy to do because the program was already in place, you don't have to reinvent it. And the MERB program just said all your soft costs, which are about 30%, right? All your soft costs you can write off in the first year. Right, so you put syndicates together of wealthy people, they put money in the deal, and they get a tax credit in the first year for the soft costs. That will definitely improve the you know, new apartment construction and so on. But a number of things have to happen. Hopefully, we've got it right, and we're going to get on the road. And my thesis, and I think it's a very credible one, is that when a problem gets large enough in a wealthy country, it'll get solved. And whether it gets solved intelligently or whether it gets solved foolishly, and it could go either way in terms of government spending, it's got to get solved, because the housing crisis has been getting worse. There's no end to it getting better. It's a long-term process, and the government is going to make changes, I think, at all levels, including CMHC, to encourage developers to build. Nobody thinks the nonprofit sector can solve the problem. It has to be the private sector for both money, skill, experience, and just overall, know-how. Okay. So I think more is coming. So rents and vacancies. Rents continue to go up at a significant rate on both new apartment construction and on the turnover of rental buildings, of older buildings. But turnover has gone down, so therefore your rent is not going up as fast. But it does turn over, you're getting big lifts. Vacancies remain relatively low. Anybody with an existing stabilized portfolio is reporting normal turn, very, very, very low vacancies. Okay. The only place that we see any stress occurring right now is in new apartment construction in, I would say, suburban, urban, and smaller and secondary markets, where the business plan was, someone's going to sell their home and then they're going to move into the building, and we built larger units and 2 bedrooms and so on, and they were going to kind of stay there forever. Because of the rise in interest rates, home sales have slowed down. So those people that were going to move into those newer buildings built for them aren't. It's nowhere near a huge problem, but that's the only place that I can see anything happening that's negative. New apartment construction in downtown core areas, the downtowns are coming back. Employment is still relatively good. That could change, but those buildings are doing well and achieving rent increases. Although we may be reaching the point where that rent increase in the A-class building is starting to level off, right? So downtown new construction, good. Small town new apartment construction, slower than anticipated because sales have slowed down. As I said, the greatest risk to the apartment business, vacancies and rents, is overbuilding, and we're nowhere near that in any place in Canada. And it would take quite a while, I think, for that to occur. But it happens in the US all the time. Okay, they overbuild there, and prices drop, rents drop, and move on to the next city and overbuild there. Okay, next slide. Let's talk about cap rates. It is hard to get a beat on cap rates today. They were lower, they're higher today. We were saying, last year at this time, cap rates are 50 to 100 points higher. That's at best. They're probably going to be higher than that. There's a lot of product that's coming to the marketplace, but it's not trading because maybe the seller wanted last year's prices and the buyer is, not willing to accept that. A few years ago, what you wanted as a broker and as a buyer was bring me a building that's treat as clear, meaning bring me a building with no financing on it. I want to go to CMHC and put financing on it for 2% or 3% for the next 10 years, and that was the building that was saleable. Today, everyone is saying, bring me a building that was refinanced a few years ago with a 10-year mortgage on it, right? So treat is clear. You bring a building to marketplace with no debt on it, or the debt's not assumable or something like that, then that is not such an attractive deal today, because people are looking at, financing a building at between 4 and 5%, or maybe more, depending on the financing. And so the cap rate can't be 4 or 5%. You need to get at least neutral leverage. And I think that there are people who would buy apartment buildings at neutral leverage, meaning the interest rate and the cap rate would be the same, because they believe in the apartment story, they believe in the rent growth story, and they've got money to acquire something. But if we try and take cap rate and we put it as a formula, okay, so cap rate roughly equals, okay, buyer IRR expectations. So what is the buyer just expecting as a yield over the long term? Because they've got other choices, right? So today you can get a 30-day bank GIC for probably 5%. So why would you buy an apartment building at 3 or 3.5% cap rate if you can get a guaranteed 5% return, with no work? Well, you would, because you believe in the apartment asset class, you get leverage, you believe rents can go up and things like that. But as interest rates get higher, then buyer IRR expectations, are going to change, and they're going to go up, right? So once you get that buyer IRR expectation, what will drive the cap rate down? And keeping in mind, cap rates going down is good, means the price is higher, is the belief that rent growth will be strong. So if I believe rent growth is going to be strong, I believe that turnover is going to be high, or I'm involved in new apartment construction, then rent growth will allow me to pay a lower cap rate or a higher price. Okay. The other thesis is that, at the end of the day, the people who've made a lot of money in the apartment sector, the people who thought about replacement cost. Okay. So even with inflation, it is driving the replacement value of that apartment higher. So the unit that cost $400,000 to build a few years ago cost $500,000 to build last year, and it may cost $600,000 to build next year, right? So when you have, and what I'm going to say here is kind of important, when you have an in-demand asset class like apartments, and the replacement value is here, but the market value is here, at some point, these two catch up. Okay, now for office, that's not true because it's not in demand. But for the foreseeable future, apartment demand is going to be strong. And I think in any functioning marketplace, replacement value and economic value catch up with each other, even if there is a dislocation in it right now. Make sense? So if you believe inflation is going to be high, you're concerned about where you put your money because it's getting eroded, then the place to be is hard assets. Hard assets, cash flow producing assets like apartments are probably one of the favorite assets to have, right? And so those are good for overall for cap rates. So believe rent growth is strong, inflation is going to be there. That's going to mean better apartment prices. But what's going to drive interest rates up, or what's going to drive cap rates up, and remember that's bad for pricing, is interest rates going up, the cost of money going up, usually means that the cap rate's going up. It's not a perfect lockstep by any means. A 1% interest rate is not a 1% interest rate in cap rates, and we've seen that, but it does move it up in trend. So there's downward pressure from rent growth, upward pressure from interest rates, and right now interest rates kind of are the story, and you're probably going to see cap rates going up. Okay. So I guess the next question then, Rod, is, and the hard thing is, where does money go? Right? You've got some dough. There's a lot of dry powder sitting on the sidelines. Well, the easiest place for it to go is in short-term GICs, right? I think I was looking at them last night. They're in the high fours, just in your regular, TD Bank, and that you can sort of buy online in a 4.5% or a 5% return. I remember it's fully taxed, so that for a lot of you gets cut in half. But that's a pretty risk-free return in an uncertain world. We stepped back, looked at the market, and we said, where is the gap in the market? For existing apartment owners, NOI is under pressure, right? And so you're going to see that a stabilized asset that was producing $1 million per year is probably not going to produce $1 million per year next year, because the operating costs are going up significantly, and the rent rate isn't keeping up, right? The one that we all have seen is insurance, which has gone up dramatically. I wouldn't be surprised to see municipal taxes go up as well. But of all the real estate asset classes, it's stable, and it's not going anywhere except for the fact that NOI is under pressure, right? Rod, let's go full screen, see if we got any questions. I'm going to say hello to some people here. Okay, can we do that? My camera's working. Okay, we got here. So there's Dave Price. Okay, Pierre Paul Tergeron, we've seen you many times over the years. How are you? You can turn your camera on, or we can read lips, whatever you prefer. No, I'm actually going to talk to you.
Here we go. Good to see you, Derek.
Good. So what do you see happening in the marketplace, man?
Something similar to you. I agree with your analysis, Derek. Absolutely do agree with your analysis. By the way, I got my license, and I see a student of mine down, Tony, saw him yesterday at the Calgary Real Estate Forum. No, I do agree with you. That makes complete sense, as always. That's why I'm a big follower of yours, Derek. Even myself, I'm holding off buying in Alberta, right? Trying to see if rates are going to come down a little bit. And according to our good friend Benjamin Toll, a second quarter of 2024. Although I have a bet with my mortgage, my main broker, mortgage broker, that I bet a bottle of champagne. He thinks rates are going to come down before Christmas because of what's going on in the US. I disagree. I agree with Benjamin Tall. So we'll see.
I would bet a good quality bottle of champagne. Fair enough, because I think you're going to win that bet. And I hear people say that, look, we're optimistic that we're going to go into a real bad economic time and they'll drop interest rates. I don't know how that's optimistic. Just my point. So we're counting on bad news to make interest rates drop so that our business can be better, right?
Yeah.
Kind of a rising tide floats all boats, but there's a ton of uncertainty here that we need to deal with. And I'm finding that in uncertain times, what do people want? They want stability, right? And so when we're putting investors in deals, they're not saying this to me, but this is really what they're saying. Derek, don't tell me how much money I'm going to make. Tell me how much I'm never going to lose. Fair enough? Yeah, I'm going to get 20%. I don't know. Will I get my money back? Then let's talk about, return on assets. Okay. All right, good. Okay. Who's this lady here? P Bunch. Hello. Say hello to us. You didn't know you were going to come on live TV today. BUSCH. Hello. What do we got here? Yeah. Peter Paw. Talk about Alberta. How are you? Look, I like coming out to Alberta. That the spirit there is better. How are you feeling about apartment development, Peter?
Captic, you always count the challenges first, right? Challenges are construction costs and getting things done. Yes. But we have no rent control here, which is of course super important for a market to adjust to demand. And yes. So yeah, you see a lot of people looking at the market and thinking of plans for new construction. And so yeah, it's definitely changed from a few years ago, that's for sure.
Yes, but Peter, would you go ahead and consider putting a shovel in the ground today?
Well, based on CMHC, and if you're in a good area, but we basically we cannot hit 6 cap rate, and so we are now retendering, and because we, like you mentioned in your presentation, you want to have a positive leverage, right? And to be honest, 1% or 1.4%, whatever the 10-year rate is now, is still very, very low. So it's very scary, right? Because you cannot make a mistake in the construction side. And but I cannot see the rents popping up that quick that you can, because you should arguably probably work on a 7% cap rate for new.
Yeah. So the thing about apartment development is it falls into like the person who's building today to sell tomorrow doesn't really see a compelling case to build today. Fair enough. But the person
you cannot be a merchant or barely. I think there is a few merchant rental developers in Calgary. They are very sophisticated. They run a couple of projects currently at basically last year's construction cost. So I think they will be in good shape. But if you run the numbers today, then it will be tricky to be a merchant developer.
Yeah. If we go back a few years ago, Peter, anybody who had a reasonable development history could get into the apartment business, build their first building, make some beginner mistakes, but the market would carry them. Fair enough? Today, that's not going to work.
No.
Yes. Prayful, my friend, tell me what you're seeing in volume of mortgage brokerage. You got to come off mute. I mean, we can read your lips, Prayful, but still. Actually, we can't read your lips. No. I bet she's saying something really brilliant right now, and we're just missing it. All right. David Price, you're having discussions with people all the time, right? What are you hearing in the marketplace? Hold on, Prayful.
Okay.
Yeah, I'm hearing people wanting to align themselves strategically and look at affordable programs. It's a common theme, but really what's happening is people need an injection of cash, and they need some
Yes.
support to secure their construction loans or on the renewal, right? They're getting into trouble. They're getting cash calls from the bank, and they need an injection of cash. So
Yeah,
that's
yeah,
the
yeah.
common theme.
On the developer side, for deals that already started, the recapitalization of a good developer in a good location with good product is probably a good business investment today. The
Yes.
recapitalization of a developer who is its first deal, doesn't know what he's doing, and is hoping for the market to carry him, that would be a concern. Okay, all right, good. Okay, Colin Gayford, tell us about training. What are you seeing in construction costs? I'm assuming you're a constructor at GC.
Yeah, I'm the CFO for Train Construction.
Right.
We do kind of projects across Canada, BC, Alberta, and Ontario, 250 to 300 unit size projects. We've been patiently waiting for CMHC to approve some of our financing applications that have been in the queue. Finally starting to see them get picked up, which is a good thing. We have shovels in the ground in our project in Colwood, and just waiting for financing to be approved so we can get going on that one. It's a $124 million loan, so it's a big project, and everybody's anxious to get started there. The economics on projects since the HST change look a lot better for us. So we're pretty excited about that. The projects that are kind of currently going, a little bit more of a challenge with interest rates and ceiling rates that are on certificates that are a little bit lower than what today's rates are.
What can you say about construction costs and where you sort of see them going?
Well, we were
Closer to the most
hopeful that we would see them stabilize and maybe even come down a little bit. We're not really seeing that. We do purpose-built rental, and we just do wood frame construction, and we've been doing it for 20 years, and we know we work with the same trades, for the last 15 or 20 years, and so we know our pricing, and pretty confident with it, but we're definitely not seeing it come down.
Yeah. Okay. So, hey, Fran Holhall is our director of research. Fran, so we do feasibility studies, right? How has the sort of client questions to us changed over the last few years, and how are their concerns different than they would have been a few years ago?
Well, everybody's interested in affordable. That's number one. Number two, if they're in the queue, etc., they're always coming back and saying, okay, now take another look at those rents. What kind of increases have we seen, etc., before they put that final application into CMHC. So there's a lot more due diligence. Not that we didn't do due diligence before, but there's a lot more pause here before they submit.
Yes. Fran, we've been doing these feasibility studies for like a long, long time, done 700 of them. I think in the good days, people didn't even read them. They said, look, my banker needs it. My partner needs it. Everyone's reading the report today. Okay. And they're coming back to us for updates every 3 months or every 6 months saying, are you sure this is where the rents are? Go back out and survey the market, and they're rerunning things, right? So the market was so strong before that whatever you did, if you started a project in 2016 and you got it done by 2018, 2019, it just went well. The market carried you. Today, people are worried about that, and people are navel gazing way more. They're being much more careful. They're being slower to start. And even if they do decide to build, and they build, let's say, a phased campus of 4 6-unit buildings, they might have broken ground every 6 months and just, building 1, 2, 3, and 4. Now you build building 1, make sure it gets stabilized, get a refinance, take some equity out if you get it, do the next one. So there's generally been a slowdown. Okay, so we've got Praful, tell us not about what you do. What's the volume of transactions for mortgage brokerage?
I don't know overall, but for us, basically, right now it's only construction financing. Otherwise, it's nothing, zero. Almost.
Right. Right. So what we're seeing is that people are just kind of stopping, right? People are stopping.
Yeah.
And so on new construction, people are stopping where they've started. They need recapitalization. I think that is an opportunity with, with the right developer. Okay. All right. So we've got Rod. Let's go to the next slide. We're going to do we do this every quarter. Our topic for January, and the session is going to be January 4th. I'm going to say that we're going to title this one tentatively the Super Bowl of Rescue Capital. Okay. And so we're thinking those of you that have dry powder on the sidelines, I know everyone's waiting for the bottom to come in. You never know what'll come in, but I think we can see deals coming. Fair enough. And they're not going to come in stabilized 1970s apartments that are kind of full all the time with below market rent. Those just aren't going to transact. There may be someone who gets into trouble in another business and says, I got to liquidate my apartment building to pay off my high-tech business or whatever it is. But there'll be a number of buyers out in the marketplace. So I don't think there could be any real sacrifices. But I think in new apartment construction, we're getting our private clients who have money on the sideline. And we've got 20 deals that we're looking at right now. Okay. Of the 20 we've looked at, we think 5 have enough equity in the deal. There's enough experience with the developer that we can put our clients' money and our money in that deal and recapitalize it and probably look forward to owning that building with the developer, our client, and ourselves for 5 years. Okay. And we see that's an opportunity. So if anybody is looking for rescue capital or recapitalization apartments, please reach out to Dave Price. And we see that as probably the best opportunity out there. Otherwise, a lot of things are probably just, going to stay sideways. Thank goodness we're in the apartment business. And we thank all of you for coming here today, and we look forward to seeing you soon. Okay, thank you. Cheers. Prayerful, thank you for coming on. Okay, did I see Glenn Hefner on there? Glenn, hello. Peter, you commented. Oh, you left. Yeah, Peter, you're there. Peter, who talked about the sale of 50 Laurier. Was that you, Peter? He's probably saying something brilliant again, and I can't hear it.
Yeah, it's Peter Drobin.
All right. Is his mic open now? Where's Peter? Is there? There. Peter, let's try it again. No. Okay, great. All right. Okay. Thanks everyone for joining us. We'll see you next quarter. Okay. January 4th. Bye-bye.